In this video, we're going to look at exercise 10-8A. In this problem, we're going to calculate total production cost, total cost of ending inventory, and the total cost of goods sold. We're given the following costs or information. During the year, it started and completed 3,000 of units produced. And may I just add that this is wonderful. Started and completed, that means there was no beginning inventory and there's no ending inventory. It makes our life so much simpler in working this problem. The company incurred the following cost. Raw materials, $6,200. That is a product cost. If you haven't yet, please watch the prior video that I created, 10-2A. It helps get in the habit of identifying cost as a product or a period cost. Wages of production workers, that's also called direct labor. Salaries of administrative and sales personnel, 3,000, not a product cost. We don't need that number. We do not need 3,000. Depreciation on manufacturing equipment, 4,400. That is a product cost. It is not direct labor. It is not direct materials. It is overhead. There are three product costs, as you recall: direct labor, direct material, and overhead. That is overhead. And then depreciation on administrative equipment. That's a period cost. We don't need that. So we don't need 2,200 and we do not need 3,000. We need the rest. All right. Now, they give us this information. Units sold, 2,400 units, and we'll need that. So hopefully you can retain this information. I'm going to change screens. And a lot of times I do not use the solutions, but sometimes they just do a really, really good job, and I go with it. So the numbers, after we eliminated period costs, these are the numbers that we had left. Raw materials purchased and used, 6,200. Let's flip back to it right there. Just using their phrases, okay? Come on, there we go. Wages of production workers, 7,400. I like direct labor, but this is how our book words things. It's great. 7,400 production workers, direct labor, same thing. And overhead, depreciation on manufacturing equipment, 4,400. So before I go any further, let's just recap what we have here. The book was intentional, had to be. It can't be accidental on what they've done. We've got direct materials, we got direct labor, and we got overhead. The three product costs, the three inventoriable costs that go into inventory. Inventory is an asset that is eventually treated as an expense, cost of goods sold on the income statement, and we only expense inventory. I say only. There is an exception if the inventory is worthless or destroyed, right, or obsolete or out of style, marked down, whatever. Those are the exception. I'm thinking, we got a good product and there's nothing wrong with it. The only time it's expensed is when it hits the income statement, and that's called cost of goods sold. But until then, it's on the balance sheet. So you add up these three product costs. Again, I'm going to recap. Direct materials is called raw materials here. Wages of production workers, that's direct labor, and overhead depreciation on the manufacturing equipment. Add them up and you have total product cost of $18,000 that was incurred in the accounting period. Well, there's some things we need to do. It said to calculate cost of inventory per unit. They made 3,000 units. So we'll take the $18,000 and divide it by the number of units made, and we'll get $6 per unit. Ending inventory in units. This is a great way of doing it. There was no beginning. There was no, when I said earlier there was no beginning or ending inventory, I was referring to the prior period. There's no ending inventory from the prior period. Hence, there's no beginning inventory in the current period. I apologize. I realized what I had said already, which is a good point. if you have ending inventory in the prior year or the prior accounting period, it is your beginning inventory in the current period. And is, you know, there's a cliche or a phrase or something we can quote, you know, that some of y'all are familiar with, you know, the last shall be first. It's a great way of remembering ending and beginning inventory. So you have ending inventory, what's left over last, it's the beginning inventory in the next accounting period or first. Okay, that's what I meant there. I realized I should have been a little bit more careful with my words when I hit that. But they didn't sell everything they made in the current period. They made 3,000 units. They sold 2,400 of those units. So that means they have some left that's unsold. Units that are unsold is called ending inventory, 600 units. And since we already know the cost of the units that were made at $6 a unit, we can just multiply that by the ending units, and we get $3,600 for ending inventory. And the cost of goods sold, the same thing. We sold 2,400 units. We know there's $6 a unit as the cost. $6 a unit times 2,400 is 14,400. That's how you get the cost of goods sold. So, real quick video on exercise 10-8A. If you have any questions, as always, please